Demand zones are the single most powerful concept in trading. When you use them correctly, they can skyrocket your results, but most traders never use them correctly. And you can see it everywhere. Traders marking zones, price hits the level, and nothing happens. The zone just fails. And they're left wondering what went wrong. And this comes down to two reasons. One, the levels themselves aren't placed right, so you have inaccurate entry levels and target levels. And two, even if the levels are correct, they're not filtering the ones actually worth trading. So in this video, I'll show you exactly how to find real supply and demand levels, and how to select the right ones to trade with laser accuracy. Now, when you're taught about supply and demand levels, it's usually going to be something along these lines. First, find a strong impulsive move, which is easy enough. Then you're going to draw a box around that move and extend it to the right. After that, you wait for the price to return to that zone and then enter once it does, and either target a previous support or resistance, or another supply and demand level. On paper, that sounds completely reasonable. But in the real market, this is over before it even starts. Because number one, you don't even know what a real supply and demand zone looks like. It looks different to everyone. One trader's zones might look completely different to another trader's zones. It might be in a different location or be a different size, and there's no real way to know which one's right. It's entirely subjective. And that's a problem in a market that is not subjective. I mean, sure, no one gets it right all the time, and everyone has their own personal style, but the market itself is always the same. There are objectively bad supply and demand zones, and objectively good supply and demand zones. And that's the problem with how most people learn this concept. It gets taught as if it's a visual exercise. It's just, find a strong move, draw a box. But there's no objective criteria. There's no standardized way to confirm the zone is actually a good zone. So what ends up happening is two traders can look at the exact same chart, draw completely different zones, get completely different results, and no one knows why. You can't figure out what went wrong, so you just redraw the zone slightly differently next time and hope for better results. And that cycle just repeats. Zones work sometimes and fail sometimes, and you never really know why either way, so your confidence never builds and your results never actually improve. You just stay stuck. And honestly, most trading strategies are exactly like this. They're mostly vague and subjective and keep you running in circles. Even if you did want to improve, you don't know where to start or what to track. There's no foundation. And on top of that, there's another issue nobody talks about, which is that the zones are temporary. They're only good for a session, but they need to be redrawn every single day. Now that might not sound like a bad thing, because new price action comes along and new data comes along, so we need to adjust our levels accordingly, right? Well, no. Once again, it sounds good on paper, but it doesn't work in practice. This one is particularly bad because it gives you the illusion that you're in control. But the market doesn't work that way. It doesn't care that you redrew your zones. It will not respect them, and it will not make it easy for you. All you're doing is adding more noise on top of it. You're essentially trading a different chart every single day, and then wondering why nothing is consistent. But real levels don't need to be redrawn, because let's think about what a supply and demand level actually is. It's a zone with heavy institutional volume and trading activity, and these types of zones are responsible for major moves in the market because institutions are the only ones with the liquidity to actually do that. The rest is just retail traders making insignificant moves, and that's mostly noise and chop. But the actual large and serious moves are just institutions moving from one supply and demand level to another. And these are levels that don't expire. So the key to finding real supply and demand zones are to find permanent institutional levels. Not something like drawing boxes at random candlesticks, but actually finding where institutions operate. These are levels you just need to mark once, and the market actually respects it and takes it seriously time and time again. Now, I have a video that goes more in depth on exactly how to find these levels, which I'll link here for you to watch after this. But once you use volume to find these levels, you now have permanent supply and demand zones that actually work. That's step one in trading supply and demand correctly. We have accurate levels. Now we can move on to step two, which is knowing when to trade them. And by the way, if you want to master finding these levels and trading them with precision, join my accelerator program. You'll get access to a custom indicator with these exact levels mapped out, as well as private one-on-one support from me and a private community. If you're interested, the link is below. Because although the levels are very reliable It doesn't mean that we need to take every single level-to-level move. We just get direction wrong too often and get a bunch of losses, because now you basically have a map of where the market is headed next. You have a clean indication of where the market is likely to move and reverse from, so you know where to target. Now you just need to find the trade. Because let's say we're opening here, for example, right? We're at a supply and demand level, and we need to take a trade to the next level above or below. We know that the market will move to one of these two levels, but we don't know which one. Because look at what happened in the past. We had multiple level-to-level moves here, with the price moving very accurately from one supply and demand zone to the other. And the thing is, catching all of these moves at the moment would be impossible. It seems clearer now in hindsight, but at the moment it's very difficult to know whether the price will move to the upper level or the lower level for the next move. So trading the levels correctly is just about knowing where and when to take the trade. And that comes down to context and market structure. The context in this case is that we had a couple of back-to-back bullish moves in an uptrend, which ended with this climactic move and sharp high, and then we dipped a little and now we're consolidating. So knowing this information, which level-to-level move do we take here? Do we go long to the upper level or go short to the lower level? Well, the correct answer would be neither. We don't take a trade at this level at all because we don't have enough information to tilt the odds to one side. The price could move to both the upper level and lower level with roughly equal probability. The only way for probability to shift to one side is if we get trend and momentum as well. And we get that in the past, right? We see that the price is in an uptrend here because it's making higher lows and higher highs. And it finally breaks this high to move to the level above. So if we were taking a trade here, we would have a strong indication that this would continue moving higher and we'd go long. But if we go back to our opening level here, what do we see? Well, it's not so clear. We were in an uptrend recently, but we had this sharp high and then a break of trend structure. We've made a lower low here and we've been ranging ever since. So we don't have a bias here at all. We're caught in between a sharp high and a sharp low. So the correct thing to do at this level is to wait. We're going to wait until price breaks one of these levels. If we break the upper level and move above this high, then it confirms that the uptrend continues and we'd go long. If we break the lower level instead, it confirms that we did indeed make a climactic high and we're about to reverse and begin a downtrend. So our edge is much stronger once it's confirmed by a break in market structure. Guessing here wouldn't make sense. Even if you had a thought or inclination, it would go a certain way. Now this is where you'd set your alerts at both the upper and lower level, and then wait for one of those levels to hit. And we see that the price attempts to make a new high but fails to break into the upper supply level and dumps. And now we've made a significant lower high here as well, along with the price dropping into the demand level and making a new lower low. The trend change here is pretty clear. We've made a new downtrend leg of both a lower high and a lower low, with a break out of this consolidation to the downside. This is the market telling us that sellers are in control and we're more likely to move down. Now we go short and target a level-to-level move at the next demand level. And that's how you take a real level-to-level trade with supply and demand levels. That's really the whole hack. It's not a trick and it's not some secret. It's just two things done correctly. Get your levels right first, not by drawing boxes on candles, but by finding where institutions actually operate, where the volume is. Those levels don't expire, they don't need to be redrawn, and the market will keep respecting them long after you mark them. And then second, don't just trade every level you see. Read what the market is telling you. Is there a clear trend? Is structure confirmed? Do you actually have a bias here, or are you just guessing? If you can't answer that, you wait. Simple as that. And when both of those line up, that's where you enter. So if you want help putting all this together, the link's in the description. And I'll see you in the next video.